August and September are usually weak months in the stock markets. Whether we will see a repetition of this pattern this year, we won't know, but we will see a recovery that is continuing, according to VP Bank Chief Investment Officer Felix Brill. Felix, the economic growth and the performance of the stock markets have been very strong after the slump due to the coronavirus pandemic. Have we seen peak growth yet in the economy?
Yes and no, I would say. If we look at the US economy, we probably have seen already the peak of growth rates. So the answer here is yes, but it's also no, because we don't expect that this is the end to the recovery, that it's running out of steam anytime soon. Quite the opposite, actually. We expect the recovery to continue, to be supported also by fiscal measures. And if we look outside the US, for instance, if we turn to Europe or Japan, there's even more room to the upside. We have not reached pre-crisis levels in GDP output yet, so there's more catch-up potential still, and there's even a high chance that we see growth rates to accelerate in the second half of this year.
What does that mean for equities and bonds?
We think that is still an environment good enough for equity markets, but not so much for bond markets. If we look at equity markets, of course, we see a bit of a challenge in terms of valuation. They are stretched in some sectors and markets. So we're entering basically thin air. But in our view, there's still room to the upside, and it's still more attractive than government bonds, for instance. And what makes us even more positive on the equity outlook is that at least in the recent weeks, equity markets were quite resilient vis-à-vis negative news, and this is a good starting point, I would say.
And how is this reflected in the portfolios?
We are strongly underweight in government bonds, and we are short duration in order to reduce our interest rate sensitivity in the portfolio. In terms of equity allocation, we are neutral positioned, meaning that we are fully invested relative to the strategic allocation, and we have a regional preference for European stocks.
And how does the increase in gold fit this picture?
Yeah, first of all, what we like about gold most is that it adds diversification to a portfolio. It makes a portfolio much more robust. So therefore, we have already reflected that by including gold in our strategic allocation. But now we thought it's a good time to add to the exposure, because gold prices have come down quite a bit in recent weeks, so it's kind of cheaper to enter the market and to add exposure, and we think there's even a chance that gold prices move up again, adding basically also positively to the performance of the portfolio. One reason and support for the gold price could stem from a weaker dollar, what we expect to happen in the coming month.
Thank you, Felix. And this concludes our View the Questions. If you like, we will be back in September. Goodbye.